You are watching Trading Day. I'm Amber Canwar. Let's get to one of our top trending trades. That is Tourmaline Oil. It is trading up here, up nearly 3%, which is unusual for a company when it is buying another company. Typically, you could see the buyer trade down. It shows just how much investors are maybe excited about the potential of them buying Crew Energy for $1.3 billion, an all-stock deal. Let's get perspective on this. Mike Rose is the president and CEO of Tourmaline Oil. Michael, thank you so much for joining us. I'm sure it's been a very busy day for you. Why don't you just take us through how this deal came about, how long you guys have been working on this, and what the merits are?
Well, we've kept the same geographic corridor for our EP business that we grow primarily organically and complement it with acquisitions when they become available. And so we've been looking at Crew for several years. It was never for sale. That changed over the course of the summer. And it fits extremely well with our Montney position in Northeast BC. So we executed a transaction, and we view it as a big win-win. It's a big win for Crew shareholders, as we didn't think their value was being properly correlated to the market, and it's a big win for Tourmaline shareholders because it really fills out our development portfolio in the Montney, both south and north now.
So that's interesting. Wasn't for sale, but then suddenly it was something that the company was willing to entertain, at least on the Crew side. What was that? Was it just kind of market conditions, a belief that it was undervalued, investors kind of shunning natural gas that you think catalyzed this process?
Well, probably all of those factors, are in there. And Crew has an outstanding development portfolio, a very large project at Birch to execute on. And I think it was becoming increasingly difficult to establish a line of sight on how to finance that. So they thought they would go and see what people would pay for it. And it was a competitive process that they ran, and we're very happy that we were the successful bidder in the end.
Okay, so there were sort of multiple parties involved. You're coming away successful. And of course, investors often turn to Tourmaline, not just because of the dividend and the play on natural gas, but the special dividend as well that you issue from time to time. From a financial perspective, how does this deal enhance your ability to deliver on those things?
Well, it's accretive from a free cash flow standpoint right out of the chute, and that is one of our acquisition criteria. And so in 2025, a combination of run rate free cash flow and some shorter term opportunities allow us to increase our free cash flow yield pro forma by 16%. And then once we execute that large Birch capital project I referenced in 27 and 28 is the most likely timing at this point, it's a 25% free cash flow accretion to our existing outlook, which is about $1 a share.
You mentioned the Birch asset. My understanding is that it will need some commitment, some investment, some capital on your end, some infrastructure around it. Is that something I imagine you guys have contemplated? Does it mean that the budget increases? Help us understand. And is it predicated on anything happening, in the market? Do you need to see certain price movements before you feel like you can deploy that kind of capital?
Well, we'd like to see 25 and 26 prices where they are now or a little higher to execute, certainly not where we're sitting this summer from an execution standpoint. In fact, we cut our gas growth, Tourmaline did, out of 2024 because of low prices. Now we're very diversified and actually realize much higher prices. We have built a lot of plants like this. This is a deep cut plant, so there'll be liquids recovery with it as well. So we think we're very well positioned from a skill set standpoint and from a market diversification standpoint to fold this into the plan. But when we updated our guidance with the Crew acquisition this morning, we just put it in at what we call maintenance capital. So keep it flat at 30,000 BOEs a day and generate the commensurate free cash flow. So neither the volumes and the growth or the capital for that Birch project are currently in our 5-year plan. And as we evolve our budget over the next few months, we'll pick the exact timing for that.
You mentioned kind of we're at the cycle low for prices. I'm curious what that means for future M&A opportunities. Do you envision that there are more deals like this or that have characteristics of this that Tourmaline could execute on in the near term?
Yeah, we don't do too many deals. Our primary growth mechanism is organic E&P, but by sticking with the same geography for the whole 16 years of the company, we kind of know what fits and what doesn't. And if our key criteria are met, we may or may not execute. And what we've been able to show this year through the bottom of the nat gas cycle price-wise is that we're profitable at the bottom, which is why we've raised that base dividend 3 times already. And given that CRU accretes to our free cash flow, it allowed us to execute on another small dividend raise just by acquiring CRU.
Let's talk about the potential of LNG Canada and whether that's a potential catalyst here, how you think about that.
Well, I think it's going to be a catalyst for prices, but it's not a catalyst for us doing this deal. This is just systematic long-term view on what's going to happen in the basin. We're not in LNG Canada. We are in the LNG game. We're actually the only Canadian company that is, but we ship our gas south and process it with Cheniere on the Gulf Coast. So we're equally excited about opportunities to the south and opportunities on the west coast of Canada. Price-wise, for our western hubs, what should happen when LNG Canada comes on stream at full volume is you'll pull about 2 BCF a day out of the basin that's currently in supply-demand balance and move it west. So that should create much stronger pricing for AECO in Station 2.
What if it doesn't?
Well, if it doesn't, then we still make money at the bottom of the cycle. But it's pretty hard to imagine that it wouldn't, just simply because we're in balance now and they need 2 BCF a day on the coast. And there's all kinds of intra-basin demand growing as well. The whole electrify everything movement, which won't physically affect demand until probably 2027, but that's another whole layer of gas demand that we weren't thinking about 6 to 9 months ago. So the future is very bright for natural gas, and it's very bright for Canada. And we're cheering on as many projects on the west coast as possible. We're in the CLIMS project, or what has been called Rockies in the past, and we're working hard to try and evolve that one along as well.